I think silver's going into several $100s, may even go as
Okay.
high as 500, and I think it will do it by summer this year. Right now, silver's only 2.1% of the price of gold, so it's still cheap historically. Maybe its spread will also reach those levels. I'm not saying we've got to go to 500. Everything else we see says this will be one dramatic and extremely fast. The worry about a correction in the middle, that's highly likely. Corrections like this did occur in that 79 to 80 surge where silver quadrupled in 5 months. You're going to get a trading type wiggle. All the doubters and the people using old metrics will say, there we go. We're going to have a major correction. You're not. We're going to suggest to people, and I'm doing this with my own portfolio, move out of the leverage stuff and just go into 100% bullion equivalents or ETFs that hold bullion or miners. So if we go to eightfold, gold to be 8,500, merely matching prior two highs in terms of multiple gain. By summertime, I expect this to be largely June, July, August, somewhere in there. Our assessment of this move in silver in particular is that it's going to a new reality. I can give you umpteen long-term verbal reasons why,
Okay.
charts included. I think silver's going into several $100s, may even go as
Okay.
high as 500, and I think it will do it by summer this year. These accelerated moves in silver, even the ones that occurred in that compressed 50-year, half-century antiquity range that surged up to $50, they occurred in a couple quarters where silver went ballistic and reached the top of that range. We're no longer dealing with that range anymore. But some of the same technical metrics that signaled the onset of those orgies on the upside in silver, where it had already been going up for years and suddenly goes berserk, was a spread relationship between silver and gold. Silver is still vastly undervalued to gold. If you go back 50 years and look at the surges in price that occurred in silver, like 79 to 80, look what the spread of silver versus gold was then. In other words, divide an ounce of silver into an ounce of gold. Back then it was 6.5%. Okay, keep that in mind. Then in the 2010-11 final 7-month surge of that multi-year bull market, silver broke out versus gold on a spread chart.
The bold $500 silver target sounds extreme until you notice how quietly the gold-silver spread has been rebuilding for years. Michael Oliver is pointing to relative value, not hype, and the key stat here is the spread. Silver once traded at 6.5% of gold versus barely above 2% today. That gap exists even after gold's multi-year bull run, meaning silver hasn't repriced alongside monetary reality. Historically, when this spread breaks higher, silver's move compresses into months, not years, often catching investors underexposed. For portfolios, this isn't about timing tops. It's about recognizing a regime shift already underway. Next, Michael Oliver explains why price charts alone are misleading in this phase.
You didn't see it looking at the price chart. Prices going up, both of them going up merrily, but that spread broke out and that announced verticality for silver that lasted a couple of quarters, just like the other one, 79 to 80. Silver went up double and a half in 7 months, but it was still confined in that 50-year range, which was sort of silly given the degradation in the money unit. If you factored where silver ought to be now versus 1980 high at 50, it probably should be $500. In fact, I think that's about right. And if you measured it against the 2011 peak when silver was 50, in that surge, again in the box, its spread was 3.1. Right now, silver is only 2.1% of the price of gold, so it's still cheap historically. We're arguing that not only has silver broken out of its range and likely to have an orgy on the upside that mostly gets done within a couple quarters, counting again from the November close last year. So December, January, we're only 2 months into this couple month thesis. That the spread might just do what price did, namely take out the highs of the last 50 years. $50 silver, $50 silver, that's gone. Okay, fast.
This is where headlines quietly fail investors. Price action hid the real signal. Michael Oliver highlights that while silver looked normal, its spread versus gold already broke out. the same condition that preceded the 1979 to 1980 vertical surge. Adjusted for currency debasement, a $50 ceiling from 1980 implies something closer to $500 today, not $100. At just 2.1% of gold's price, silver remains historically mispriced despite breaking a half-century range. That's not speculation. That's relative valuation math Wall Street rarely mentions. Up next, Michael Oliver explains why relative performance may matter more than absolute price.
Why not challenge the relative performance highs because silver is still cheap? Why not challenge 3%? Why not challenge 6.5%? Price took out those highs. Silver's still cheap. Maybe its spread will also reach those levels. You do the math on what silver, if continue gold up, what silver might be at 3% or 6% of an ongoing bull trend in gold. It takes you off the page.
Wow.
Another metric here. Now, pardon me for going too long here.
No, it's all good. It's all great.
If you look at an idiot price chart, arithmetic scale, go back to 75. You've got that range that was like from $4 lows to $50 highs. So, call it a $50 range or a $45 range. And if you see a price range like that and you break out, the orthodoxy of price analysis is to, take the thickness of the range and add it to the range. That's your swing objective. Well, we reached that about a week or so ago when we were in the 90s, mid-90s, 95 area. That matched the swing objective of the dimension of that range. And you found there was a lot of selling there. I don't know if you remember what it was. We had some pretty sharp hourly sell-offs in that range. We finally blew those guys out. So it's no longer an issue of, double the range. When you look at silver on a ratio scale chart, logarithmic, same period of time, go back to 75.
Most investors stop at the first target, and that's usually where mistakes happen. Michael Oliver points out that classic price-measured objectives around $95 have already been met, which explains the heavy selling and volatility seen recently. But that arithmetic logic ignores how long silver was trapped below fair value. On a relative basis, matching even 3% of gold implies radically higher prices if gold continues its own bull trend. This is where risk management matters. Traders focus on resistance, while long-term holders focus on structural repricing. Next, Michael Oliver shifts from arithmetic to logarithmic logic, and that changes everything.
The bottom of that range was $4 and you go to 50. Okay, well, that's like a tenfold move plus. So a geometric or logarithmic scale, ratio scale. How much did silver go up? Tenfold from the bottom of the range to the top. You broke out of the range. The logarithmic swing objective of that same range on a ratio scale chart is $500. Because you break it out at 50, tenfold is 500. Don't laugh. Okay. Now, I'm not saying we've got to go to 500, but I am saying everything else we see says this will be one dramatic and extremely fast. And yes, the worry about a correction in the middle, that's highly likely. And what we're doing at MSA right now is trying to deal with that issue for our subscribers so that if they are itchy, or let's say they've got leveraged positions, and they've got call options, things that, they don't particularly want to have to suffer through a correction with. We're going to try to measure when and where that occurs. Our suspicion right now is, one, the factors that would define that. And by the way, corrections like this did occur in that 79 to 80 surge where silver quadrupled in 5 months. And doubled in half between September 2010 and April 2011 on the way to $50. There was a correction in each of those right in the middle of that clock, like a month 3, let's say, either side of that.
Logarithmic charts quietly explain why silver shocks investors when it finally moves. Michael Oliver is clear that a tenfold breakout from a 50-year base isn't fantasy. It's how markets historically reset after suppression. In both 1980 and 2011, silver corrected roughly 15% mid-move before accelerating higher, shaking out leverage players. That matters today as options and leverage have exploded across commodities. For investors, the lesson isn't fear, it's positioning. Volatility is part of repricing, not proof the thesis is wrong. Next, Michael Oliver explains why the biggest risk may be getting shaken out too early.
Where you had what you could call a correction. It was only 15% in each case, by the way.
Okay.
But it was enough to cause people to think, that's the top. What
Mhm.
happened on the other side of that was even more than what had happened in the first half of that couple quarter move.
Right.
So it's going to be interesting. I suspect you're going to get a trading type wiggle that all the doubters and the people using old metrics will say, there we go. We're going to have a major correction. You're not. I think you're going to have a wiggle, something that interrupts it for like a month. And then when you come out of that, that's when you get the next burst. That's our assessment.
Okay. Look, thank you for being so detailed there. I'm still kind of in shell shock from just the number of $500 an ounce silver. But man, from your lips to God's ears, buddy. Let's hope that happens. So here's what I kind of take from what you just said, and you tell me if I'm capturing it correctly. You think silver has this tremendous amount of potential energy still to be unleashed,
Yes.
going forward. You're totally open to the fact that there could be some corrections along the way, even though you expect this rocket ride to arrive relatively soon, like in the next 2 quarters by summerish.
This isn't a bullish promise. It's a warning about how markets shake out weak hands before the real move. As Michael Oliver has argued before, corrections under 15% in secular bull markets often function as liquidity resets, not trend reversals. Historically, silver's sharpest rallies followed brief consolidations that lasted weeks, not quarters, especially when leverage cooled without breaking structure. A 1-month wiggle can feel catastrophic to traders using outdated valuation models, but it often clears positioning for the next impulse. For investors, the real risk isn't the dip. It's misreading a pause as a top and exiting too early. What comes next explains why timing mistakes here can be more costly than volatility itself.
So by summertime, I expect this to be largely June, July, August. Somewhere in there, I expect it to be the large part of the move to be totally accomplished.
To be totally, yeah. So, from one point of view, and I'm guessing this is sort of yours. So we're not talking about your subscribers right now who tend to be more active, I won't use the professional, but I'm sure you have a lot of professional investors there, but people who are more sophisticated, right? My guess is you would say to the average person who is a silver investor, especially if they own physical ounces that are a little bit harder to trade in and trade out, just say, don't worry about it. Just sit tight. If there's a pullback, just don't sweat it. Just don't look at the tape for a while and you'll be taken care of by the time summer comes around. Is that more or less accurate?
Yes, that's dead right. In other words, we're going to caution heavily when we get to the point where we think there's a correction. And I suspect if there's going to be one roughly midpoint on the clock, it's going to be late February, early March, probably at much, much higher prices for silver and for gold, but just it'll be lagged to silver. Okay.
The real message here isn't optimism. It's behavioral discipline under pressure. Michael Oliver has consistently pointed out that physical metal investors are structurally different from paper traders because friction reduces emotional decision-making. With silver pullbacks often clustering around late Q1 in prior cycles, the February-March window fits historical seasonality rather than signaling failure. If prices are already materially higher by then, volatility becomes a test of conviction, not fundamentals. For long-term holders, especially those owning physical ounces, the cost of over-monitoring price can exceed the benefit of tactical moves. Next comes the part most investors underestimate: how fast missed re-entries can erase patience.
So I think there will be one, let's call it a month from now, okay? And when that occurs, we're going to caution people that if you're not leveraged and if you're invested in, just outright ownership of miners, which I think is a place to emphasize right now, or silver, but it's unleveraged. If you choose not to flinch during the correction, that's fine, because the real problem with each of the corrections we've seen in this lethargic advance in silver has been that when it turns up, you don't get a chance. If you don't really astute, you miss getting back in because
Right.
suddenly whap, you're back to the highs.
Right.
So one, it's important to get out right, and two, to get back in right. So it's really tricky because these corrections, if you go back and look at the archive, the action in 79 to 80 and to 10 to 11, boy, it was tough to get back in because when it turned, it just boom.
Right. It
Yeah.
moves before you can react.
So
And
it's a real risk if you
yeah.
do get out during that correction, unless you've got, again, we're going to suggest to people, and I'm doing this with my own portfolio, move out of the leverage stuff and just go into 100% bullion equivalents or ETFs that hold bullion or miners.
And the miners. Okay.
Yeah.
This is a lesson written in past cycles and paid for by those who tried to trade every dip. Michael Oliver often stresses that silver corrections in strong advances are asymmetric. Downside is slow, upside is violent. In both 1979 to 1980 and 2010 to 2011, silver retraced briefly, then reclaimed highs within days, leaving sidelined capital stranded. That's why leverage becomes the silent enemy. It forces decisions under stress and magnifies timing errors. Unleveraged exposure reduces the need to be perfect in execution. What follows reframes silver not as a trade, but as a structural reset years in the making.
But I think on the other side of this, there's going to be a new world. And I think silver's going to a new reality, meaning gold's gone to a new reality for 50 years. Look at the 80 peak, then look at the 2011 peak, and look where we are now. Those were eightfold moves, each of those bulls. We're only fivefold right now from our bear low. So if we go to eightfold, gold to be 8,500, merely matching its prior two highs in terms of multiple gain. Silver was confined in a 50-year range all during that time. Why? Gold wasn't. Heck, copper wasn't.
Yeah. A lot of people think intentional suppression. Are you in that camp?
I think it's quite valid or whatever. But when the market makes mistakes, and you know this being involved with the markets, whether it makes a mistake of being excessively overpriced, let's say the dot-com top, when it corrects, it overcorrects.
Right.
It has a tantrum the other way. So when the S&P went down from 2000 to 2002 in that bear market, the dot-com breaking bubble dropped 50%. NASDAQ dropped 82%, almost wiped itself out. It overcorrected for the dot-com. And we've got anyway, silver has been the opposite.
This reframes silver not as lagging, but as compressed by decades of distortion. Michael Oliver has noted that gold's two prior bull markets both delivered eightfold gains, while silver remained trapped in a half-century range, despite similar monetary tailwinds. Markets that suppress price discovery don't resolve gently. They overshoot when released, just as tech collapsed 82% after 2000. Silver's underperformance may be the imbalance that fuels its eventual excess. For investors, this isn't about conspiracy, it's about mean reversion on a historic scale. Next, the implication is sobering. Normalization may feel extreme because it is.
It's been underpriced relative to anything you want to measure, to gold, to the S&P 500. It's now just freshly broken out versus those other assets, versus gold, versus the S&P. So this is really something that just began in a big way. An asset clash. Silver's going to seek a new reality. And if that should logically be monetary factors factored in, let's say 300, I bet it overshoots it by a couple hundred in a tantrum. So that's why you can be a bit outrageous here and make such.
And I'll give you a chance to come back on in the future and update us on this.
Okay.
But given that, I mean, it makes me think that maybe when silver hits $500, you might tell people, hey, prepare for it to now go down.
Correct, back to 300 or something.
Exactly.
Not back to 50. Okay, that reality is going to be left behind.
Right. The 50 is, but 300 might be the new.
Yeah, maybe the new reality should be logically and again, monetary factors out, the money supply growth, where should silver be? It might be 300 or something. So whatever it might be, I bet you overshoot it. And then you go back and live in the new reality. Okay.
Yeah. So I think one of the things you're saying that silver has more than almost anything else here is, it's got true price discovery going behind it.
This is where long-term mispricing quietly flips into violent price discovery. As Michael Oliver points out here, silver breaking out versus both gold and the S&P 500 signals a regime shift, not a cyclical bounce. Historically, when relative valuations snap after decades of compression, markets don't normalize smoothly. They overshoot, often by 50 to 70% before stabilizing. A move from an implied fair value near 300 toward 500 wouldn't signal excess. It would reflect delayed monetary repricing, catching up all at once. For investors, the danger isn't the eventual pullback. It's assuming old price anchors like 50 still matter. Next, the analogy he uses explains why this adjustment may feel disorderly rather than gradual.
And this analogy has been used around gold, but I think you're saying it's much more, it's even more relevant with silver, which is the beach ball that's been held underwater.
Yes.
Right, it's been held underwater. Finally, it's escaped the hands that were suppressing it. It's now shooting higher, and just like a beach ball that's held underwater, it'll burst above the waves.
Yes.
And that'll be the overcorrection. It'll come back down to the waterline, right?
Quite. That's a good analogy. I think that's what's underway. I think it'll be quick. And then the issue you mentioned a while ago that I didn't address, stock market weakness. Right now, we think the stock market is topping. Last 3 months, we've been arguing it's got to continue up, though. Get above 7,000, which it did today, but probably even more. Probably at least get into February before it decides to roll over again. But we think it's a broad topping process of major proportions. It is going into a massive bear market when asset class breakage occurs, like in the T-bond market, the dollar stock market bubble breaks. But I don't see crash-like event based on technicals, which usually will warn you, oh gosh, you're breaking something big on the momentum. Then oh, there it collapses. Momentum usually, we do have those structures in the S&P below, but they're far below. Requires getting down around 5,400 anytime this year.
The beach ball analogy matters because it explains timing risk most investors underestimate. As Michael Oliver notes, suppressed assets don't rise linearly, they snap, overshoot, then retrace toward a new equilibrium. That overshoot often coincides with stress elsewhere. And here, the S&P nears 7,000 masks, weakening momentum beneath the surface. A potential decline toward 5,400 would be painful but structurally slow, not a crash, draining confidence just as silver spikes. For portfolios, this creates a divergence moment. Metals absorbing capital while equities quietly lose leadership. What comes next ties this silver breakout directly to a much bigger gold narrative.
Well, heck, we're 7,000. So any break we have between now and then could be arduous, slow, not a panic. If you go back and look at the history of gold since it became legal in the U.S., eightfold moves. You had a 50% drop from the $200 high when it was legalized in January 1975. Collapsed to a low in 76 of 103, so a 50% bear market. Okay. Starting from that low in 76, it went up eightfold in 3.5 years, $850. Then in 2001 and 2, it bottomed again, this time at a higher level than it had been in the decades before, at $265. Took it 10 years, but it was an eightfold move, 1920. We started from a bear low at 1,050. What's eightfold? About 8,500. Okay. Yep. So even if gold just goes to 8,500, which most people would think is ridiculous, it's only matching the geometric dimensions, the multiple gains that it produced in the prior two bull markets. In other words, it's only done it again, ordinary. We have extraordinary fundamentals out there.
This reframes ridiculous price targets as historical math, not speculation. As Michael Oliver has emphasized, gold's prior secular bulls weren't anomalies. They followed similar geometric expansions after deep bear markets, A move to 8,500 would simply replicate 2 previous 8-fold cycles, not exceed them. What's different now is the backdrop: higher debt, larger deficits, and tighter trust constraints than in 1976 or 2001. For investors, the implication is sobering. Dismissing these levels ignores precedent, while fundamentals are arguably stronger than ever. Next, he explains why gold's role itself may be changing, not just its price.
So where might gold go? At least to match the old highs, metrically, for the logarithmic scale.
So at least
but
85.
probably well beyond. And I don't have a target for gold, but here's my outcome. I don't think you end up with a bear market. I think gold becomes monetized. And once we in the Western world find out that we can't trust government debt markets, we can't trust governments, therefore, okay? We can't trust the stock market as an alternative. All of a sudden, we're left with one thing, and you create political chaos, as we're already starting to see.
This isn't a price call. It's a trust crisis hiding in plain sight. As Michael Oliver suggests, monetization isn't about gold trading higher. It's about gold replacing failed confidence in paper systems. When government debt loses credibility and equities can't absorb capital safely, capital seeks neutrality, not yield. Historically, that transition coincides with political instability, currency volatility, and policy desperation, rather than clean market signals. For investors, gold stops being a trade and becomes insurance, against both markets and governance.